think that looking forwards, we've got a much more challenging environment ahead as investors. Over the last 4 decades, buy and hold has actually worked pretty well. Sure, there have been some stocks that have obviously been the sort of key drivers of those returns, but most asset classes basically have enjoyed pretty good returns. There have been a few bumps along the way, and most of the industry is actually geared to investing in that way. And we think that that is actually a pretty high risk approach to take, given the sort of kind of things that are going to drive returns over the next decade or so. So we think looking ahead, you've got a valuation starting point which is very elevated by historical comparison. We've got highly financialized economies in the West, which means that the volatility of markets is going to remain more significant in the future. And we're likely to have an environment characterized by somewhat higher inflation. We're not envisaging a return to the 1970s, but inflation is likely to be heading up, and that has some fairly material implications. So how do we actually, what do we use to actually try and sort of think about capital allocation in the years ahead in this rather different environment? Well, I think that it's quite helpful to actually have a thematic construct, to look through a thematic lens at the key thematic drivers that we believe, the key structural drivers that between them are going to basically have a powerful impact on returns, both in terms of understanding where the headwinds are, and which are deleterious to returns, and also to understand where the key drivers are, the tailwinds. So essentially, you need portfolios that are more heavily biased towards the tailwinds, and capital allocation is going to have to be much more precise if we're to generate the kind of returns that investors need, rather than actually simply riding the waves that have got us to this particular point. So I'm going to skip through each of these primary themes. I'm not going to go into it in detail, but I just want to bring a few points alive, and then we'll draw things together towards the end. So this is our thematic framework. Again, we think it's useful to sort of try and think in terms of hierarchies of related themes. Obviously, there's a lot of interaction between these themes. If we went back to the 1980s, again, basically it was globalization and disinflation that were the primary things. And then from the 1990s, technological change started to have a very significant impact. And more recently, obviously, we've seen the rise of China having a profound influence on the global economy and also investment returns. The resource industry being a great example of a beneficiary of that. And in the meantime, obviously, we've seen significant demographic change, and we've seen a massive buildup in debt. So all of these factors are going to be shaping the environment, the investment environment that lies ahead of us. So just touching on demographics, people are pretty familiar with this. It's obviously driven down growth rates very significantly. Japan was obviously the first big economy to suffer from a declining working age population. And the interesting thing in a way is that Japan is coming out of the other end, in the sense that basically it has dealt with some of these issues. And it's deleveraged very significantly. And now, in a way, basically, it's very underrated. But by and large, demographics, are in the price, arguably. And so that presents some interesting opportunities. But by and large, this is demographics, going to remain difficult. They're going to get worse in China, but the real big problems for China are going to be in the next decade. And the US is actually relatively well placed, interestingly, whereas Europe has got to face very significant demographic headwinds. Turning to debt, we're all aware of the massive accumulation of debt across the world. Even China basically has a debt to GDP ratio of approaching 300%, which is a level at which starts to become somewhat challenging, and that is going to shape policy significantly. And they're going to be winners and losers. But the key point really here is that financial repression is going to remain with us for some considerable time. And that is going to tend to actually have a downward influence on inflation. It would be much better for governments if they could inflate their way out of the problem. We don't think that that is entirely possible. And so therefore, we're going to be in an environment where real interest rates probably remain pretty low. And returns on bonds, whilst not completely catastrophic, are going to struggle. So there's a lack of defensive assets that we need to take into account. Moving ahead, the rise of China, we're seeing a multipolar world emerge. I think that the Taliban's takeover of Afghanistan recently marks a very important, it's the final brick in the Eurasian bloc. That is going to be dominated by China. And China is very serious about moving up the value chain. And I think that is going to be very challenging for a lot of businesses in other countries that formerly exported to China. So, your customer becomes your competitor. And that's very true of Germany, for example. Again, we're in this emerging multipolar world with friction between the US, the two big powers, the US and China, which raises geopolitical risks, and it means that basically the shape of the world economy is going to be more complex than that we've been used to over the last 30 years or so. Moving on to technological disruption, Tim obviously talked about this really quite a lot. We basically agree. We think we're in a time of very significant technological change and disruption. And you've got to be on the winning side because being on the losing side, it involves extinction. And there's a very important, so are we going to be in a value or growth environment? Quite simply, I think we're going to be in a growth environment. There will be value rallies, but by and large, it's about growth. And it's about creative destruction, and it's about new technologies continuing to diffuse through economies. And we could list them. I mean, AI is going to become increasingly important. Biotech, basically, and medtech are going to be very, very significant. And being on the right side of that change, I think within portfolios, where outcomes can be pretty binary, is going to be extremely important. So it's exciting in terms of new growth opportunities, but it's damaging if you're in the losers. And then finally, climate change. That has been bubbling under the surface. It's clearly been a challenge for some time, but in terms of the sort of reaching a pivot point in terms of regulatory change and acceptance that there has to be a significant effort to address these challenges, is now in play, and it's happened relatively recently, and we're playing catch up. And what this means is that there is going to be a very significant fiscal tailwind, and there's going to be a very significant flow of capital into the energy transition that's got to take place. And again, this is going to upend whole industries. We've already seen that reflected in the relative market pricing of, for example, energy stocks. And the big winner, of course, is solar. And there we can see Moore's law applying, with the decline in prices of solar. And ultimately, if it's not profitable, it's not sustainable. And I think we're sort of moving into a period where effectively, it not only is this going to be a more sustainable form of energy generation, it's actually going to end up lowering prices, and that will have very significant impacts. So what are the investment implications? Well, it means that the returns to broad market beta are going to be challenged given the valuation starting point. Prevalence of high debt levels underpin this sort of market fragility. So it's not going to be easy. And you can approach that in two ways. You can either basically be more dynamic in terms of making asset allocation decisions and contracyclical, or you can basically stick with your long-term investing view. And I think at the moment, the industry is about sort of managing around benchmarks, and I think that is going to be profoundly challenged over the course of the next decade. It'll take us about 5 years to wake up to the fact that is the case. And that's going to basically have a significant impact, I believe, on the passive industry. And within active, you're going to have to be really active. That doesn't mean in terms of turnover, but you're going to have to be active in terms of the precise allocation of capital to the winners if you're going to actually generate the returns that will basically keep your investors. Real and nominal interest rates remain very low. That's obviously great if you're running a growth business. Inflation somewhat higher. I mean, there's a lot of hysteria about inflation at the moment, and we think that it's somewhat less transitory than the Fed would have us believe and other central bankers would have us believe. But on balance, the headwinds remain significant. And also, we'll see falling prices in a lot of areas too, which tend to be underestimated. So no return to the 1970s. But somewhat higher inflation rates internationally than has been the case over the last 10 years or so. Demographic headwinds, they're real, they're very powerful, they impact growth, but there are ebbs and flows. And the ebb is in there's a bit of flow in the States for a bit, which is going to boost US growth on a relative basis. And again, other nations have significant challenges. We talked about technology extensively, and again, Tim made the point about economic gravity shifting. And at the moment, basically, Asia is massively underrepresented in investor portfolios. But you've got to invest in Asia in the right way. But look, if we project ourselves 10 years forward, what proportion of the winning portfolio is going to be invested in Asian-focused businesses, whether they're listed in Asia or outside Asia? And I submit that basically it's going to be 50% plus, and that's a very different environment. So why drift towards that? I think you've got to be preemptive, and I think you've got to make some big strategic calls if you're going to basically generate the returns and capture this particular move. It's quite interesting. Obviously, in the short term, Chinese stocks have been challenged. There's all this stuff about, they're still communists and so forth. And they just got a rather different culture of capitalism to us. But that doesn't mean you can't make investment returns. And of course, most of the growth of the middle class and middle class spending power is going to happen in Asia. So making sure that is a big part of portfolios is obviously important, and looking through the sort of short-term volatility such as we've experienced recently is important. It's an investment opportunity. It's this sort of, you've got to have that kind of mindset in the sense that when the market suffers a bout of volatility, you've got to be asking not about how much can I de-risk. You've got to say, right, what are the things I want to buy that this is giving me an opportunity, giving me great entry points into? And then the energy transition, solar is what it's all about. But there's a lot of mispricing. And I think one has to have a valuation discipline. There are fads and fashions in these things. And our focus is principally on the picks and shovel stocks that are providing key technologies that will drive the energy transition. And here are a sort of subset of more granular ideas. There are more than that, but again, I think that you can populate portfolios with great ideas pretty much on a buy and hold basis over the next decade. And even if returns to market beta are low over that period, I think that the alpha opportunity of simply investing differently and being more thematically focused, I think can still result in great returns for investors. Thanks very much.